If you were to invest 100,000, by the end of 5 years, when you add everything together, you've got almost 200,000. You've almost doubled your money in 5 years.
And of course, all of this is still subject to risks associated.
Of course, nothing is guaranteed. If anyone says it is guaranteed, run.
Hello and welcome to the Indian Community Podcast, where we bring you stories and insights from leaders who are making a significant impact in their fields. I'm your host, Amit Gupta, along with my co-host, Rahul Mehra. Today, we have a very special guest and a very close friend, Ankur Chadda, founder and managing partner of Foxtail Capital. He was born and raised in the United Kingdom, and Ankur has studied law and real estate in London. And he has also transacted over $200 million in real estate deals. Ankur is in pursuit of the American dream and has now moved to San Diego, California, where he has founded Foxtail Capital to bridge the gap between high-earning, time-stricken professionals and experienced real investors. Ankur, it's great to have you on the show.
Hi.
How are you doing?
Really good. Yeah, thanks for having me, Amit.
It's 6 o'clock in the morning.
It is, yeah. You know, I'm an early bird. I like the peace in the morning. So yeah, no, this time works well for me.
Excellent. Ankur, can you tell us a little bit about what inspired you to move from the United Kingdom to the United States of America and also founding Foxtail Capital? And is there a story behind the name Foxtail Capital?
Yeah, sure. No. So yeah, look, I was born and brought up in the UK, spent all my life there and really had no plans of moving anywhere. I was doing well there. I've always done real estate in the UK and all my family and friends are there. But, got married sort of 7 or 8 years ago to an American girl. And, we'd been living in the UK for a few years, but, COVID hit. And, I think during COVID, everyone sort of started thinking a little bit more about, life's too short. Let's try something different. So it was literally a quick decision that we made during COVID. And we thought, let's move to San Diego and start fresh. And that's what we did. So straight after COVID, we moved here, and I wanted to continue my career in real estate. And I've generally always been on the business and corporate side of real estate, and sort of took my time here in networking and understanding the markets and realizing that real estate is the same pretty much everywhere when it comes to the fundamentals. And I started Foxtail Capital last year, which has been exciting. When it comes to the name Foxtail Capital, I'm a work at home, so I'm a remote worker. And when I look out a window, I see a foxtail palm tree, and that's the palm tree that I focus on when I'm thinking. And I just Googled and I said, well, what is that palm tree? And it's a foxtail palm tree. And so I named the company that. So a bit of a funny story behind it, but yeah, that's the reason behind the name.
Well, that's a beautiful story, in fact. And interestingly, of all the places that you could have been to or immigrated to across the world, why did you choose San Diego?
Yeah. Look, I think the US was always going to be a place that I wanted to move to, amazing opportunity, and obviously married to an American girl, it was easier for me to move here. But then we had the whole country to choose from. So weather was at the top of my list. Living in the UK all my life, I didn't want to move somewhere cold and wet. I wanted to live somewhere where there's nice weather. So it was, California was sort of one of the top. And I know I didn't want to be in the Bay Area or LA, and San Diego really just had that balance of sort of work-life balance where I could bring up my kids somewhere where we can spend a lot of time outdoors, but also have enough around me where there's opportunity as well. So yeah, San Diego sort of ticked a lot of the boxes.
I was expecting you would say that.
Yeah.
That's an interesting story and a very nice name you kept, Foxtail Capital. It took in a palm tree. So I am into, branding and all. And this is the first time I've heard somebody say that, that's such an honest answer.
Yeah, look,
Otherwise, they
exactly.
go
I
up
mean,
for it.
it's I think everyone has those times of the day when they're in thinking mode and planning, and you're always staring at something, and I'm always staring out my window, and that tree was there, and I had to find out what it was called. So yeah, it was an easy decision to call the company that.
So, Ankur, my question to you is, you know, we see you actively promote build to rent and multifamily real estate.
Yeah.
So, what are build to rent and multifamily real estate in the first place?
Sure. Yeah. So multifamily real estate is typically apartment buildings. So it starts as small as a duplex or a triplex or a fourplex, but also goes into the larger apartment buildings that you see, 100 unit, 200 unit buildings. So it's rented accommodation for people to live. Build to rent, however, is something in the middle where um, there is a demand out there for rented accommodation, but for people who don't want to live in apartment buildings. And so people still want to live that American dream and have a single family home with a yard and a driveway, but one either can't afford to buy in this market, or at least for the foreseeable future, and two, want that flexibility and don't want sort of the burdens that come with home ownership. And this is a demand that has been sort of bubbling over the last 10 to 15 years. And really now it's growing. So there's particular markets in the country where master planned communities are being built purely for the rental market. So there'll be one owner, one investor, and all of these houses that are built, they're all for the rental market. So the multifamily and build to rent are similar in the fact that the end user is going to be a renter who is looking to live somewhere, but they're two sort of slightly different asset classes.
So you mentioned one owner, one investor. So is that specific to build to rent? So does that mean that that particular unit or that house is owned by one investor,
Yes.
whereas in a multifamily there may be multi-investors?
No.
Is
So
that
yes, what I meant was not one particular person or investor, but it would be one entity. So one
okay?
entity will own the whole master plan, rather than sort of a number of people owning separate houses. So it'll be one
Got it.
entity, and yes, a number of investors could get involved in investing in that entity.
Got it. Got it. And how do you or where does Foxtail come into the picture with these kind of deals?
Yeah. So, I mean, my background has always been commercial real estate, and I've done a bit of multifamily in the UK, but I spend a lot of time in sort of offices and retail and hotels. But for me, when I moved here and I sort of assessed the landscape, multifamily and build to rent just felt like the right asset class to be investing in, purely because of what's happening in the country. I mean, on the sort of demand and supply side economics, remote working, lack of affordability to buy, and sort of that flexible lifestyle that people are having now, really, I think we're becoming a renter nation. And if you see in sort of 15 to 20 years time, I think the majority of the new population will be renting. And so what is going to be in line with the renter nation? It's investing in multifamily real estate, it's investing in build to rent real estate. And that's where I think the demand and growth is going to be. So that's where I started Foxtail Capital. I thought, I know that I want to invest in these properties, but these are large properties, multi-million dollar properties. And so how can I bridge the gap between sort of my experience and being able to find the right deals and assess the right deals, and then bring investors alongside me who may not have that experience and time, but have the capital and the will to invest in such deals.
Got it. That's very interesting. So you work with both the entity, which is a group of investors, and then you also help investors become these entities. Is that interpretation correct?
Yeah. So how it works in the typical world is either a syndication or a fund, and that is the typical structure that we use when investing in these opportunities. So it's simply put as we'll pool investor money together and then invest into these properties. And it's split between the general partnership and the limited partnership. So us as the operators and the people who are finding these properties, we're called the general partners, and all of the liability and responsibility comes down on us. So, we're structuring the deal and putting everything together. The investors come along and they are called limited partners because they're in the limited partnership. And so the investors don't have any responsibility, but also they don't have any liability as well. So we're liable for everything, and the limited partners have the majority stakehold, the majority of the equity in the property. So typical splits will be sort of 80% to the investors and 20% to us. And, we're getting that equity in exchange for all of the work and all of the things that we're doing to put the deal together. And then the investors get the majority of the equity because they're bringing in the money.
That's excellent. And Ankur, this is the Indian Community Podcast, right? So we have to talk about the Indian community here.
Definitely.
And it is also one of the most active community that invests in real estate, especially when I was house hunting in Atlanta.
Yeah.
Every time we would go to a house, we would see a queue of other Indian home owners or home buyers waiting to see that house, right?
Yeah.
So I've seen a lot of people queuing up to kind of see houses, and I would see a lot of Indians actively doing that, and that's also because the way we think of real estate as an investment, right? So we don't treat real estate as a liability. That's not how we are programmed. We are programmed to think of real estate as an investment.
Yeah.
I was also seeing this news this morning, which was about DLF in India, where they sold close to about 800 flats, each worth about 7 crores in just 3 days, right? So you're selling eight 800 flats, each worth 7 crores in 3 days. That's I just don't understand how they managed to pull that off. So hats off to DLF for that. But that also talks a lot about the Indian community that is actively looking at real estate as an investment vehicle. Right now, a lot of people look at India as that destination where they want to invest because they're kind of familiar with the land, the law of the land.
Yeah.
A lot of people have grown up in India or they were raised in India, so they kind of understand the country in that sense. But now they're in the US or in Canada or in UK, and they don't know much about the laws over here.
Sure.
So, do you think onshore real estate is something that the Indian community should actively look at? Because I know a lot of people, they all own one house or maybe two houses, and the other one they've kind of rented it out, and
Yeah.
the mortgage is being taken care of by the rent, right? It kind of gets offset. But when you talk about build to rent and multifamily real estate, so that is a very new asset class for a lot of first time investors.
Yes.
What do you recommend? Is onshore a strategy that they should consider and also include into their portfolio?
Yeah, no, great question. And look, that the whole thing about India's real estate market. Obviously, India is growing at such an amazing pace, and especially if you're from India and you've spent time there, then you like you said, you have that familiarity, and you want to deploy some capital in India. What I would say is that it might feel that there's some instability in the US economy right now with what's going on with war and inflation and all these things. But in my view, it's it's cyclical, and recession or no recession, I think there's no doubt that US real estate is still one of the world's safe havens. And so I think whilst there's opportunity in India for crazy returns, I still think that the market is volatile. And, it's important to maybe deploy some capital in India and, maybe, have that there. But if you're really looking to deploy capital in a safe haven, I think US real estate is still one of the best out there. And the same goes for European countries as well. So what it comes down to is, I think that obviously the maturity of the economy, but the rule of law here as well. So in terms of deed, ownership, and landlord and tenant law, US real estate still follows common English law, which, in terms of economists, they still see that as the strongest when it comes to owning real estate. So putting everything aside, I think it really comes down to what your goals are and what your circumstances are. So, if you're living here, you're working here, and maybe realize that the barrier to entry into buying real estate here is actually pretty tough. And maybe you can buy one house or two houses, but in order to scale, it might be difficult. And so you think of different ways of investing, and India is always an option. Or could buy some land in this area, or buy a flat, or I could invest in this development. I think those are great options, but it's important to really understand the crux of how the developments work, and having some transparency and communication with the sponsor or whoever is managing that deal. And for me, and I've always said this, being an informed investor is the most important, rather than sort of riding waves, or being sort of emotionally taken around as, should I invest here or should I invest there? I think it's understanding the basics of everything first, setting your investment goals, and then diversifying your portfolio, which might mean, right, deploying some capital in India, deploying some capital in multifamily real estate in the US, maybe some stocks, maybe some gold. It's key to be diversified and not be emotional when it comes to investing in life.
That's great. You did not mention crypto.
No, crypto. Look, I only invest in things that I understand. I'll be honest, I don't understand crypto. I don't understand words. So a lot of my friends have made good money in it. I'm sure they've lost money in it as well, and they haven't told me. But I stay away from it personally.
Stay away. Likewise.
So, Ankur, you spoke about the barriers to entry and specific rules and laws for in the real estate sector. So, I wanted to know: can individuals on an H-1B visa or those living outside the US invest with Foxtail Capital?
Yeah, no, great question.
If yes,
Yeah,
okay,
definitely.
yeah.
So, to invest in the US real estate in general, you can be a US person or a foreign person. So, from the IRS's perspective, and look, I'm obviously not an accountant, but the IRS sees you as a US person if you're a US taxpayer with a social security number. So, whether you're a green card holder or a H-1B visa holder, you're a US taxpayer, and so you're able to invest in US real estate. But even if you're not a US person and you don't have status in the US, you can still invest in US real estate. Now, the only barrier to that is that generally you would need a tax identification number. So if you don't have a social security number and you're living in India or living in the Middle East or the UK or wherever it may be, it would be key to get an ITIN number, which is an individual tax identification number. So you can set up your bank account here, open up an LLC, and then use that entity to invest in funds and syndications and things like that. It's a lot more cleaner. Otherwise, there are tax issues, and it's important to speak to an accountant. But when you're on a H-1B visa, you, in the IRS's eyes, you're a US person. So we've had people on those visas invest in our deals before. Obviously, the concern is sometimes that on that visa is that you might not be living in the US permanently. And I know that's been a concern with some investors as, "Oh, if I'm not here in 3 years' time and this is a 5-year deal, then should I be investing or not?" And, I think it comes down to obviously your goals and your circumstances, but irrespective of where you live, holding US assets, is always a good thing. So whether you're here for the long term or not, being on that visa, I don't think matters.
And Ankur, you have mentioned 5-year deal, or there may be a time associated with these deals. So, what is the typical time that it takes for a deal to kind of mature, and what are the returns that people have seen in the past in this segment? Um, and the third part of my question is, what are the most hot investment opportunities that you're working on these days?
Sure. Yeah, no, great question. So time period wise, I mean, how a typical deal would work is that the types of deals that we look for are deals generally where we can add value. And so when we're looking to add value, that would mean, sorting out the operational inefficiencies, renovating the internals and externals. So this sort of stuff takes time, and there is generally a stabilization period of 12 to 18 months. And then we're plain sailing and we're generating a lot of cash flow. And so in order to maximize returns, our typical hold period would be around 5 years. And it can be less and it can be more depending on the market. But investors are normally in for 5 years. And
Okay.
how it works return wise is there will be cash flow distributions every quarter. And then when we sell, as the investors are equity stakeholders, they will get their share of the profits as well. So you're looking at typical cash flow distributions between 6 and 8% on the capital invested. And then you're looking at an equity gain as well. So when you combine those things, you're looking at an average of between 15 and 20% per year on your money. So, for example, if you were to invest 100,000, by the end of 5 years, when you add everything together, you've got almost 200,000. You've almost doubled your money in 5 years.
That is excellent. And of course, all of this is still subject to risks associated,
Of course,
right?
yeah,
So,
yeah, definitely. Look, there's risks in obviously every investment and everything that we say. Nothing is guaranteed. If anyone
Mhm.
says it is guaranteed, run, because it's not the case. Everything is projected based on um, d- real due diligence when it comes to the numbers and comparables that we're looking at. So the two main questions that I always get is, what are the risks for investors, and can I lose all my money? And we always look at return of capital and return on capital. The most important thing first is the return of your capital. Are you going to get your money back? And uh, the answer most of the time, of course, is yes, but there is always risk. So I always say that the only way that investor equity is totally wiped out is if we can't pay the debt service on the properties. So if we get to a position where we can't pay the mortgage anymore, then either the property goes back to the bank or investor equity is wiped out totally. And in general, that will only happen if we're buying something that is generating hardly any income, and we have bought it in the wrong location. We didn't project properly of what the rental market is there, or the expenses have gone through the roof. And we make sure in our due diligence period that we make sure we're buying real estate that is already generating income. We take out fixed rate debt and project conservative numbers when it comes to big expenses like taxes and insurance. So, for example, now, a lot of people got into this game sort of in 2020, 2021 when interest rates were super low. And they bought properties on floating rate bridge debt. not knowing what was going to happen in 2 or 3 years' time. And now those properties are underwater because the general partners there are paying 10 to 12% in interest rate when they had underwritten the property at only a 3% interest rate. And so
Correct.
investors have lost their money in those situations. And, that is when it can get a bad name for itself. And that's why it's very important to sit down with the general partner and understand exactly what their assumptions are and how they have managed risk in their projections. Because if you're not projecting conservatively, that is when you can really go into problems in this business.
And what are the most hot opportunities that you're working on, which you can talk about?
Yeah, sure. So we've just closed on a deal in Texas. So that was an 80-unit apartment building. We bought that for 6.8 million. That's in Victoria, Texas, in south part of Texas. And yeah, that is a typical value add deal. It's a 5-year hold, and we're going to be spending the first sort of 12 to 18 months doing the repairs and renovating the properties and pushing the rents up. And on that, what we've actually done is assumed the seller's debt. So they took out a loan at 4.25% a few years ago, and we've been able to take over that loan. So we have low interest rate to start off with, which is really good. And we'll be generating cash flow of 8%. And overall, it will be an 18% average annual return for investors.
That's excellent. I mean, that's already sounding profitable.
Yeah, no, it's sounding good. And then we've got another deal in Greenville, South Carolina. That's a build to rent deal. That's 26 units, brand new construction. And, it's in a very hot market in terms of rental demand. So not much value to be added there. It will simply be rental growth, and it's more of a capital preservation deal, but still returns we're looking at between 15 and 17% per year.
That is great. Those numbers sound really good,
Excellent.
especially in a country where my savings account gives me 0.000001% interest, right? So anything that gives you over 10% is a great vehicle.
Well, yeah, exactly. I think double-digit returns is something that is obviously very favorable, but it all depends on your risk level as well. So you're looking at treasury rates at the moment, we're at 5.25%, and we see treasury bills as the barometer for zero risk. So betting on the US government, you're getting 5%, which is better than nothing. And so I would always say to investors, from that point, how much risk are you willing to take in order to get the better returns? And so we always say that in multifamily, the risk adjusted returns are a lot higher than other asset classes because the risk is generally lower than, say, investing in individual stocks, but you're still getting those double-digit returns as well. So yeah, it's a great asset class to invest in.
You spoke of opportunities. So I would like to understand, how do you qualify opportunities for you to consider?
Yeah, no, great question. So location is obviously the number one focus for us to start off with. So there are certain locations that we like to invest in. Typically, it's the Sun Belt area and the Midwest area of the United States. We don't invest generally in states that are anti-landlord focused. So states like California, Massachusetts, New York, Oregon, Washington, those blue states are probably not the best places to invest in operational real estate, just because it can get risky in terms of eviction laws and rent caps and things like that, where things like that really get in the way of investor returns. So we focus on markets like Texas, Carolinas, the Midwest, where we can get good cash flow, and there's strong regulations in terms of landlord favorable laws. So that's the first one is location. Two is obviously the property. So we generally know the areas very well, and so supply and demand is super important. So we see what the demand is in the area, see if there's an oversupply or undersupply. Once we tick those lists, then we move on to the actual property itself. So the property, we look at the financials, so the T12, which is the trailing 12-month accounts, and we see where the opportunity lies with the operating expenses. Are they too high? Are they too low? Where is the opportunity? And if everything works in our underwriting model, only then we will put an offer in. So, we can look at 100 deals and probably put in 10 offers and get one. So it's really a 1 in 100 game for us. So it's not easy finding these deals, but when we do find it at the right price, then we carry out our due diligence and make sure we're investing in the right thing.
That's great. So that's a very detailed process, and I'm assuming it takes a lot of hard work and effort to actually qualify something as yes, because there's also a lot of responsibility on you, right? So it's not just your own money and time that you're going to be investing, but there is investors that are going to be coming along with you. So when it comes to others' money, I think the level of responsibility increases dramatically. And I'm very glad, Ankur, that you're doing all of this due diligence to make sure that people find the right opportunities.
Well, yeah.
And that takes me to my next question. Now, while you're doing all of this for investors, but that doesn't mean that investors don't do this themselves, right? So, what would you ask investors to always be looking for before entering into a real estate investment? What are the kind of uh, green flags or red flags that they should be looking at? And when should they stay or when should they run?
Yeah.
And what are you doing? I know the answer, but I want my listeners and viewers to know about this to help people learn more about investment and how do they become an informed investor. What are you doing to solve that knowledge gap?
Sure. Yeah. So look, people obviously want to get into real estate, and a lot of the times they don't know how because there's just so much noise, and there's always real estate gurus saying you should do it this time, you should do it that time, you should time the market, don't invest here, don't invest there. There's so much information out there. So what I say to investors first is to firstly understand what your goals are. Why do you want to invest into real estate? Is it just capital preservation and you just want a rental and you just want someone to pay your mortgage for you and leave it like that? Or do you want cash flow for passive income? Are you looking to save for a wedding fund or a retirement fund? The why is first very important because that will dictate on, what you should be doing next. So once you've done that, really, I think it depends on, do you want to be an active investor or do you want to be a passive investor? And so an active investor is obviously someone who's doing everything themselves. And if you don't have the time or expertise to do that, then obviously that's a difficult thing to do. So an active investor is someone who is either buying a rental or buying something and fixing it up and flipping it themselves. I think that is a lucrative way of doing things if you know what you're doing. I would say stay local. Investing out of state when you don't have the network or the team on the ground, I think is quite difficult. So invest where you know and do your due diligence. So I would definitely have a look at what the comparable rents are, the comparable sale prices are, and just make sure you're doing your numbers and you have enough buffer to make sure that you're not paying out of pocket every month. But if you don't have that time and that expertise, then I would still learn what the basics are and maybe consider something in the passive side. So whether that's investing in a fund or a syndication or in a real estate investment trust or doing some private lending, whatever it may be. There's many ways of getting into it, but education is key. So listen to go on to webinars and learn a little bit more about how real estate actually works before sort of taking that step. So there is a process. It's not just like investing in an index fund and just leaving it. I would always learn and become better informed before placing your capital in a property or with someone who's going to invest for you.
And what are you doing to actively promote investor education?
Yeah, so I've started an educational platform called the Informed Investor. And so these are webinars that happen every 2 weeks. We had one last night, which is called the Indian Dream in America, which went into sort of how to invest for prosperity and generational wealth. But really, these webinars are to help investors learn a little bit more about real estate investment in general. And so I go through the nuances and I have a different topic every 2 weeks. So if you're looking to learn a little bit more, then, you can get the link to my website. But there's loads of resources out there. I've got a free video series as well called The Basics of Being a Hands-Off Investor. Investor 101, I've got ebooks. So I think reading and listening to podcasts and things like that is the first thing that investors should do.
Absolutely, yes. And I love the email series that you send out. There's so much of information in there, and it's written in a way that I can understand. So I do not come from an investment background. I come from a creative background. For me, investment is all jargon, but I think when I go through your emails, it makes me more comfortable. So I would definitely recommend people to subscribe to Ankur's newsletter because there's a lot of wealth of information that's coming out of those newsletters.
Yeah, well, that's the key, isn't it? It's using language that everyone can understand, because there's so much jargon out there, and sometimes we can be pigeonholed and think that everyone understands what we do. That's obviously not the case, and so real estate and investment needs to be understood on both sides. So yeah, I like to simplify things because that's the way I understand things. Real estate isn't difficult, but it does need to be simplified. So yeah, that's what I aim to do for investors.
So Ankur,
Beautiful.
despite you giving them very too much of simplified information and everything, there are still lazy investors like myself who would not read through the things and take unnecessary risks.
Yes,
So for those investors, what safety measures and risk management strategies does Foxtail Capital implement
sure.
typically to protect investors?
Yeah, no, good question. So I think the main safety guards would be, one is the legal structure. So as mentioned before, limited partners in the deal, they have limited responsibility, but they also have limited liability. So within that legal structure, it means that we as the general partners carry all the liability and the limited partners don't. So, if the tenant was to try and sue the owner for something, then the limited partners are protected in every single way. So, they don't have to sign on the loan or do any credit check. Everything is on us. So I think that is the main concern from investors first. But secondly, we like to make sure that interests are aligned. So obviously we invest our own capital as well, but we set up a structure in such a way that we don't make money until investors make money. And I think that's one of the main safeguards for investors and gives them peace of mind that we're not just making money if the deal does well or not. That's not what it's about. We need to make sure that our interests are aligned. So we will include something called a preferred return, which means that until the investor return hits a certain average, we as general partners don't make a penny until that is met. And I think that's super important. And then thirdly, it's transparency and communication. So with our investors, it's not they invest and then they don't hear from us in 5 years. It's monthly regular updates. It's knowing how their money is working for them, pictures and videos from the property, full transparency if things are going right or things are going wrong. They're kept involved. So those are the main three safety guards to really protect investors and give them peace of mind. But all of the other things that happen before we acquire the property. So it's the underwriting. So ensuring that we're not over projecting the rents, we're not over projecting the sale price. We make sure that the property taxes that we're projecting over 5 years, is going up in line with inflation. The insurance isn't too low. We make sure that every single number in our underwriting is projected in a conservative way, so that there's a buffer. So if we've projected a certain return, that's the minimum we're going to get. So I'd rather sort of under promise and over deliver rather than over promise and under deliver, because that's the most annoying thing from an investor's perspective. So it can be seen as sales, but it's not. This is we're partners rather than me selling an opportunity. It's sharing an opportunity for us to invest together. And I think it's that mindset that we're partners rather than being a broker. That's the main mindset that we like to have at Foxtail Capital.
Absolutely. I think that's very important, Ankur, because it's not just that the returns are going to help them, it's also going to help you, right? So if you've got stake in it, that's when people realize that and understand that this is a partnership, this is not a sales transaction.
Sure.
I think they look at it very differently. So it's a long-term relationship, and I don't think investors invest in one deal and then they stop investing, right? So if once they invest and see returns coming in, they invest regularly. So
this is a get rich slow way of investing. And you have all the ads out there, invest in this deal, and passive investing, you'll be able to quit your job. That is not the case. This is very much a long-term strategy. And the key is to try and invest in these deals every year. And once you've hit that 5-year mark, 10-year mark, that's when you start to see that snowball sort of get a lot bigger. But yes, like you said, this is a long-term game. It's a relationship. And investing your capital with someone who you don't know that well is definitely a leap of faith, and comes down to trust. And that's why this is a relationship business, where I like to build and nurture my relationships first, and only when we have that trust and they know how we work and they know how it all works, that is when they're happy to sort of take that leap of faith and invest.
Absolutely. I've seen you in action, Ankur, so I'm sure anybody who meets you and talks to you is going to feel the warmth and the trust that you bring along.
Thank you.
I'm confident about that. And I think we spoke a lot about real estate and the technical world and all of this complex subject. What is Ankur Chadda in his personal life, right? What do you do to unwind? Because I'd seen one of your LinkedIn posts where you described your schedule, and I was like, and this guy, like an early bird, 6 o'clock, he's at his desk. So how do you balance all of this?
It's not easy. So we had twin boys just over about a year and a half ago now. So we've got 2 babies running around the house, and it's chaos. It is chaos in the house, but it's great. I love being a dad, and really that's why I wake up in the morning. Is they are my sort of motivation and my reason and my why I'm looking to build a real estate portfolio. It's so I can buy back my time, and so I can work. And I think working is great and I enjoy it, but really I'm looking to buy back time so I can spend time and be a good dad. So that's really my number one. How do I balance everything? It's sometimes it's balanced, sometimes it's not, but majority of the time it's about time management and blocking time. And I found that to be very useful. So I'll block time and I'll try and be as disciplined as possible and have a 4:30 alarm, wake up at 4:30. And so I have that time to myself where I can work out, read and do the things that I need to get prepared for my day. And then that way I know I'm ahead, and then I can take out maybe an hour for the kids here. And in the afternoon, I can take them to the park and still get my work done. So, um, balancing isn't easy. And I know we all have families, and it's tough, especially when you're running and building your own business. But your why is the most important, because otherwise you're doing it for the sake of it, and that's when you lose love, and that's when you lose the discipline. So I would say to anyone out there who's trying to balance, just write down why you're doing it, and write down your goals for the next 5 years, and that's when you break them down, and then it's just easy waking up at 4:30.
Excellent. I think there was one saying in Hindi, and I don't know if I'm phrase it right, but when I see you, that's what it reminds me of, or when I see your schedule, right? I'm going to try and say this in English. If you want to beat the sun, rise up before the sun, right? So you rise, you're out there shining even before the sun is shining. So that's one way to beat the sun. Yeah, and I wish you all the best. Um, May your venture shine as bright or brighter than the sun. May you find investors uh, who who trust you and are also able to grow their portfolio with all the advice and recommendations that you bring to them. So, Ankur, this was a wonderful session. We really enjoyed it. I learned a lot about real estate and investment, especially multifamily. There were things that I wasn't aware of, and this was very informative. We would definitely recommend anybody who's watching this show to follow Ankur on social media, visit his website, reach out to him, subscribe to his newsletter. There's a wealth of information hiding in that brain, and we are very glad that you are also sharing this with the diaspora very actively. So thank you so much for what you
Thank
do,
you
Ankur.
for having me. Thank you very much, both of you. It's been a pleasure to be here.
Thank you.
you.